So here's a terrifying article I found saying Amazon by itself as a stock is responsible for more than a third of the S&P's return for 2018 so far. And yeah, so let's just go over this for a second, and then I will talk about why this is a bad thing. So here is a chart. It's showing the money inflows as a positive number, money outflows as a negative number into the tech sector in billions of dollars. Now, in 2018, we're only halfway through, so the rest of the year is just annualized as a straight line. But it's compared to all the years going back to 2002. So we can see that '02 through '08 were all negative. People were taking money out of the tech sector, and then we had the market crash. People started putting money back in, especially with auto reinvesting, passive investing, and money started to come back in. A little bit came out in 2012. A little bit came out in 15. Some more came out in 16, but then 17, 18 just straight up. Um, and then 18 is actually going up twice as fast as 17 did. So lots of money is going into the tech sector. And Amazon by itself has accounted for 36% of the S&P's gain for this year, which is kind of amazing. It's just an amazing number. The top four stocks, Amazon, Microsoft, Apple, and Netflix, have been responsible for 84%. And the top 10, which is Amazon, Microsoft, Apple, Netflix, Facebook, Google or Alphabet, MasterCard, Visa, Adobe, and NVIDIA, accounted for 122% of the S&P's gain so far this year. So how can it be 122%? Because the other stocks in the S&P 500, there you know, there's 500 stocks, this is just 10 of them. The other 490 accounted for minus 22% of the S&P's gain. So, on a 3% gain, which we've had so far, let's see what that is. 3% or 22% of 3% is 0.66%. So the other 490 stocks in the S&P 500 have decreased by a little over 0.5%. And here's a quote from a Morgan Stanley guy saying, "In equities, our team thinks that U.S. tech is vulnerable as a sector where pricing has been insensitive to trade risks so far." Okay, so that's kind of a mealy-mouthed way of saying it. That basically everybody's just putting money into these 10 things. And then, so why does that matter? Why is that a bad thing? Our index is supposed to even things out, winners and losers, all that kind of stuff. And yes, that is the theory. However, when you have such market concentration in just a small number of issues like this, then it only takes a little thing for things to go way bad. So, so far it's been working out okay for 2018. We're seeing lots more news of the Fed raising rates, and we're starting to see crises emerge in emerging market currencies. We've been seeing the problems in Argentina for the past couple of weeks. Can't remember which banker it was. It might have been India, India's central bank, who said that unless the Fed reverses course, it's going to start a contagion effect, starting in the emerging markets and then spreading throughout the rest of the world, creating the next crisis. And I kind of think that's right. But whatever the case is, when things go bad, because it's always a matter of when, markets change, trends change, everything goes through cycles. When that goes bad, when the gains are concentrated in so few of these stocks, when these start to go down, everything else is going to go down even at an accelerated rate. So we're going to see huge market declines very quickly and enormous volatility when these ones start to go down. Now, there's a little snide note in here talking about David Einhorn is down 19% this year because basically these tech stocks are on his bubble list and he's short them, and he's got a point. They are in a bubble, but you can't fight the tape. That's the old story. So whenever you think something is overvalued, it's not enough just that they're overvalued and that they'll go down, because that's not how markets work. Trends go on way longer than you think they should. Um, I think it's kind of, Keynes's one quote that I think is actually correct is that a market can stay irrational longer than you can stay solvent, which I think Einhorn is figuring out here, hopefully. Um, but yeah, it's just a very, very bad sign when there's almost zero market breadth and all the gains are concentrated in a couple stocks in one sector. So when everything else is doing poorly and then those turn, it's good night. So I wrote an article the other day on the cheapest hedges that we have available to us, mainly gold and U.S. bonds and euro bonds, and then some commodities and commodity currencies like the Australian dollar. Uh, it's because of stuff like this. This is yet another sign of the top. So, we're seeing it all over the place in all different asset classes, all different markets. So just, be aware and, get your house in order because the storm is a coming.